Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We are in week 1 here at UDC in the spring 2022 semester. And today we're going to be talking about how to record and analyze business transactions in accounting. And before we jump into today's lecture, I just want to quickly point out where we are in the classroom. So as you gain access to Blackboard and you're getting in, you'll open up our classroom here, and it'll look just like this under Course Content. So just scroll down Course Content, select Module 1 and Week 1, and you'll be able to find all of the information for this week right here. Chapter 1, which we talked about on Monday, and today we're going to be talking about Chapter 2. You can download the PowerPoint presentations. You can review the learning objectives, participate in the introductions discussion, complete the Chapter 1 quiz, and after today's lecture, be able to complete the Chapter 2 homework. Everything is open and available right now, so you're more than welcome to work ahead. My recommendation is, if you do not have the textbook yet, is to review the PowerPoint presentations and the video lectures before attempting the quizzes and assignments. That would be ideal. So normally we have these lectures only on Mondays. However, this previous Monday, we ran out of time to cover both chapters. Because it was the first day, we went through introductions and reviewed the classroom and all that stuff. So that took quite a bit of time. But normally we'll be able to get through both chapters on Mondays. So today is an exception. And also next week is an exception. Next week is MLK Day. Martin Luther King Day is on Monday, which means the university is closed on Monday. So because of that, two things will happen. Number one, I'll be able to provide you with previous recordings. And number two is I'll hold class on Wednesday to cover chapters 3 and 4 for next week. Thank you for your question. Okay, let's go ahead and jump into it, shall we? Let's talk about how to analyze and record transactions. And just as I had mentioned earlier, I will throw in a couple of examples, some real life examples. I try to make everything as relatable to you all as possible. And I'll tell you what, when we go through this chapter, you'll never look at a transaction the same way again. Because in the back of your mind, you'll be thinking about, oh, what does it mean for the business? I went to Macy's, I bought this red shirt. What does it mean for Macy's? Right? There'll just be things you'll think about next time you're out shopping. It's just something that kind of sticks with you. One thing we will talk about today is this concept of debits and credits. Debits and credits can be somewhat confusing for some individuals because when you think about a debits and credits, you think about your checking account. That's how most people who've never gone through an accounting course before think about debits and credits. Debits and credits simply means that we debit one account and we credit another account with every single transaction. And debits, for asset accounts, to increase them, we debit them, which is the opposite of what you might think when you're looking at your checking account. So that's one caveat to debits and credits, and I'll talk a little bit more about that when we get closer. So let's take a look at transactions. What is a transaction? What are the steps to processing that transaction, and what are the type of documents we need to process a transaction? The word transaction simply means there's an exchange. So one way of thinking about an exchange is you went to Macy's recently and you purchased a piece of clothing from Macy's. I pick on Macy's because it's one of my favorite retailers. So you go to Macy's and you decided, I really like that jacket over there. I'm going to purchase it. So you pick the clothing off of the rack and you go over to the cashier. And it's set the second that barcode gets scanned by the cashier, that begins the transaction. A transaction is an exchange for goods and services for something else, usually money. Right? Sometimes it could be an even exchange, like product for product. But in most cases, the exchange is for goods or services in exchange for cash. That's a typical transaction. So when we're purchasing that jacket from Macy's, when you bring it to the cashier and they scan the barcode, right? That starts the transaction. As soon as that barcode reader hits that barcode on the jacket that you're purchasing from Macy's, what's happening there is the computer is registering the sale, and it's taking the jacket out of inventory. Okay, and it's taking it out of inventory because you're purchasing it, right? So the second you walk out that store, it's out of their hands, right? So the barcode reader hits the barcode, it takes the jacket out of inventory. The cashier will say, oh, the price of the jacket is X. You pay them with cash or credit card or whatever, purchasing it from them. And then that's where the transaction takes place. So let's think about that transaction. How does that transaction look on paper? Well, there's a couple of things that happened here, right? The event was you purchased the jacket. The source documents here are inventory register and the receipt that you receive. Those are what we call source documents. That is how we track the transaction. And how does that transaction affect the accounting equation? Well, for Macy's, it affects the assets accounts, right? So when you purchased the jacket from Macy's, you reduced their inventory and you increased their cash, right? You purchased the jacket, so Macy's takes your cash and you take their inventory. Cash, as we know from the previous chapter, is an asset account. We also know that inventory is an asset account. I'm increasing my assets, cash. I'm decreasing my assets, inventory. And so I'm affecting just one side of the accounting equation, but it's still in balance because of the cash and the inventory, right? And we'll talk about those types of transactions, how they impact the accounting equation. We'll also talk about how we record those transactions in this thing called a journal. The word journal in accounting is like what you would consider a ledger. A journal is a subsidiary ledger. It's a journal is the information that is the transaction. That's what a journal is. And we write that journal information to our ledger accounts. A ledger account is each account, each asset account, each liability account, each equity account is considered to have its own journal, its own ledger. Okay. And so each transaction is recorded as a journal to the respective accounts, right? The ledger accounts. And after we've recorded our transactions, we prepare and analyze this thing called a trial balance, and then we record everything to the financial statements. This is all a part of what we call the accounting cycle. And we'll talk all about that. So let's break each step down one at a time. The first part of recording a transaction is identifying the respective source documents. This is how the transaction originates. How do I, what information do I use to record the transaction? This would include things like bills from suppliers, sales receipts, checks, purchase orders, payroll records, bank statements. These are all what we call source documents. Source documents is essentially the piece of paper, right? The check. It's the check or the piece of paper that represents the transaction. Okay, it's a purchase order is something that the company would fill out to tell their suppliers, hey, supplier, I need to purchase the certain amount of quantity of a certain product at this price. That's a purchase order. You send that purchase order to your supplier. Your supplier then sends you what you ordered based off of the purchase order, and they send you a packing slip, and the packing slip represents everything that's inside the box based off the purchase order, right? These are all called source documents. They're the original documents that we use to identify the transactions. And we enter this information into our accounting system. An accounting system is like QuickBooks or M3 or Oracle or Excel, whatever. It's however you are keeping your books, right? Your accounting books. It is the system that maintains the transactions. It maintains the financial statements. That's what an accounting system is. So think of it like a computer software that maintains all of the data for the transactions that have happened within the business. So for a small business, they probably use QuickBooks. They might use NetSuite. They might use Sage 50. These are all accounting softwares that individuals use. And so all the data from the transactions are entered into that accounting system. So let's break it down to the smallest detail, and we'll talk about what is an account. An account is a record of an increase or decrease to an asset, liability, revenue, equity, revenue, or expense. Think of an account based on what we call the chart of accounts. A chart of accounts represents a list of all accounts used by the company. An account, for example, would be the cash account. An account, for example, would be accounts receivable. Another example, for assets, the accounts are cash, accounts receivable, property, plant, equipment, inventory. These are all asset accounts. An asset account helps the company to generate revenue. That's what makes it an asset. An asset is something that the company owns. An asset is something the company owns. I own my cash. I own my property. I own my plant. I own my equipment. I own my inventory. And all of these things help me to generate revenue. I use these things to generate revenue. I sell my inventory to generate revenue. I use my equipment to manufacture my products to then sell to generate revenue. So when you think of an asset, think of something that helps the company to generate revenue. Those are assets. Those are asset accounts specifically. Liabilities, as you may recall from Monday's conversation, is that liabilities are anything that the company owes to someone else. That's a liability. Liability accounts are accounts payable, wages payable, taxes payable, short-term liabilities like short-term loans, the current portion of long-term debt such as a mortgage, student loans. These are all liability accounts. Remember, it's anything that the company owes to someone else. That is a liability. Right? Then we have equity accounts. Equity accounts are what the owners own. That's equity. Equity. When you think of equity, think of like if you own a house and you've been paying down on your mortgage, you're building equity, right? Equity is what you own. That's what the owners own. Equity is the difference between assets and liability. That's equity, right? And equity includes things like shareholders' equity, bonds, owner's equity, business equity, which is revenue minus, which is net income. Those are all equity accounts. So when you hear equity, think what the owners own, right? It's the difference between assets and liabilities is equity. That's the difference between assets and liabilities. Then we have other accounts like revenue and expense accounts. Revenue accounts would include things like sales revenue, which comes from the sale of inventory. You might also see a line item called service revenue. For businesses that provide a service, their revenue account would be called service revenue, like a lawyer or an accountant or a dentist or somebody who provides a service, like a lawn care service, a plowing service, whatever, right? A hairstylist, a barber shop. That on their revenue, it's called service revenue because they provide a service. Right? So their revenue is called service revenue. When they if they sell a product or they sell inventory, it's called sales revenue. And there might be a few other revenue accounts here and there. So those revenue accounts. And then expense accounts. There's a ton of expense accounts. The list goes on and on. For example, rent expense, utilities expense, telephone expense, let me think, wages expense, office supplies expense, etc. The list goes on and on. An expense is simply an expense. It's the company paid it to purchase office supplies. That's an expense. So all of these different accounts are used in the process of what we call the general ledger. And the general ledger is a record of all these different accounts we just talked about that are used by the company. Think of a general ledger like your checkbook. You know, there's so many different line items on that, right? For cash coming in and cash going out. That's a general ledger. And it represents all these different accounts. So remember the accounting equation we talked about on Monday. It's this thing called the accounting equation is assets equals liabilities plus equity. And on this slide, we see a nice representation of all the different type of asset accounts, liability accounts, and equity accounts. Those are the ones that I just talked about. It's a nice graphical representation. Remember, asset accounts are anything that the business owns: cash, land, property, plant, equipment, accounts receivable, notes receivable, prepaid account, supplies. Now, here's one that you're probably wondering, well, Dr. B, prepaid account, what is that? What is a prepaid account? Can anyone tell me what is a prepaid account? What does that mean, prepaid?
Money that you put, so basically, if I, okay, can I use a secure credit card as an example?
You could, yeah.
Okay, so in order for me to, okay, so I have bad credit. I can't get a credit card because I have bad credit. In order for me to try to get hopes of a credit card, you get a secure card. So in order to do a secure card, which means is you'll have to use your own money. So if I wanted to get a $200 credit limit or $500 credit limit, that's how much I will have to pay first in
Correct.
order to get that credit amount.
Yeah, good example, Makia. So let me ask you this, Makia. Why would that be an asset account, do you think?
Because it's I put my own money into it.
Correct. That's correct. Yep, you're using your cash, right? And so you have a claim to that cash. So if Makia says, you know what, I changed my mind, I don't want my money sitting there, she could pull it back, right? So that is correct. Very well done. That's a nice example. I like that one. Another example would be, let's say you have insurance. Most of us have insurance for something, right? We have car insurance, house insurance, whatever, life insurance, whatever, right? Insurance. Insurance is a great example of a prepaid account. Here's how it works. So I personally, I pay my entire years of car insurance up front. So every March 1st, I'll pay for the whole 12 months. Okay. That is called prepaid insurance. I'm prepaying for the whole year. Okay. That's an asset to me. The reason why prepaid insurance would be an asset account is because I still have a claim to that money. I can cancel that policy and take that cash back. That's why it's an asset. It becomes an expense when it's consumed. So after each month passes, I would write what we call an adjusting journal entry to represent the consumption or the use of that insurance at the end of each month. But that's why prepaid accounts is considered an asset, because until it's used, you still have a claim to that cash. You can still use that cash for other purposes. That's one of the caveats about prepaid accounts. Good discussion. The next type of accounts, as you know, is called liability accounts. These are what the business owes to someone else. So anytime you owe something to someone else, it's called a liability, right? Example would be accounts payable, notes payable. Notes payable, it means a loan. It's the same word as a loan, right? Notes payable. That's a loan. Examples of those would be things like a mortgage or student loans, or some type of business loan that's long term. Here's the difference between short term and long term. Short term means it's payable within 12 months or less. That's short term. In accounting, anything that's called short term, that's 12 months or less. Anything greater than 12 months is called long term. Okay. Short term, 12 months or less. long-term, greater than 1 year. Accounts payable, that's short-term. I owe my bills typically within 30 days, like the rest of you do, right? So that's what accounts payable is. Accounts payable represents bills that you have received but have not yet paid. That's accounts payable. I have to pay them still. That's why we call it accounts payable, right? Notes payable, that's long-term loans. Accrued liabilities. Accrued liabilities is liabilities that I have accrued over time. Examples of those would be wages payable, taxes payable. We accrue them over time, right? When you work, you're at work, right? You're making I don't know, $20 an hour, right? And let's say every hour that you work, you have to pay Uncle Sam 30%, we'll say. 30% of all of your wages goes to taxes. It gets separated between federal and local, federal, state, and local. And so 30% of all of your earnings goes to taxes. So every hour that you work, we're accruing that liability. The business is taking that 30% and holding it, okay? And then at the end of those 2 weeks, the business will send those taxes that they've been holding on to the IRS, to the DC government, to the local government. Okay. They're holding on to your tax money and then paying them on your behalf. That's why when you look at your pay stub, it'll say gross pay minus deductions minus taxes equals net pay, right? Those taxes and those other deductions, your employer holds on to that for you, and then at the end of the 2 weeks, they pay that for you to the respective tax agencies, right? That's called accrued liabilities. It's a liability to the business because they're holding on to your money and then paying it to someone else. That's a liability, right? Make sense? Go ahead, Zach.
Just a quick question about the taxes. I know it might be a little off topic, but do businesses receive some sort of a benefit for paying taxes for their employees, or is it just the expected norm of today?
No, it's expected. It's just a normal part of operating business. No,
okay.
the businesses don't get anything out of that.
Yeah.
It's just a normal part of operating their business. So by law, it's actually governed by law. So the law says if you work for someone, all right, Zach, let's say you work for my company, okay? So Zach works for my company. He's an hourly employee, and I pay Zach every 2 weeks. And when I pay Zach every 2 weeks, I give him his net pay. And on his pay stub, it'll say that Zach paid federal tax, state tax, local tax, and then any other deductions, right? The employer, me, I have to take that tax money out of Zach's gross pay. I have to hang on to it. And then I have to, at the end of those 2 weeks, then I have to pay that money to the IRS, DC government, and the city government. Okay. That's my responsibility by law as an employer. I gain nothing from that. The employer, in fact, there's no benefit for me doing that. That's what I have to do. That's my responsibility as an employer by law. Does that help to answer your question, Zach?
Yes, that answers my question. Now, one just additional question. If I wanted to do my own taxes at the end of the year, can I tell my employer that I want to pay my own taxes and keep that money? I know situations vary.
It depends on your type of employment. So if you're a standard W-2 employee, W-4, W-2 employee, the answer is no. You cannot do that. If you are a 1099 employee, meaning you're working by contract, then yes, you could if you're a 1099. But that's typically the only situation where would be a possibility. Good question.
Understood.
Cool. One other type of liability we need to talk about is this one called unearned revenue. Unearned revenue. Okay, here's the difference between earned revenue and unearned revenue. Revenue, as you know, is when the company sells something. Okay? So if I sell bottles of water, okay? And when I make the sale of the bottle of water, the customer pays me with cash, or they'll put it on their their account receivable. Okay, meaning they'll pay me later. That's fine. That's earned revenue. Remember, it's earned when the customer has received the good or the service. That's when revenue becomes earned. It is unearned revenue when the customer pays the company but has not yet received the good or the service. Here's an example. Let's say Zach and I, we own a landscaping business together, okay? And every year we go around the neighborhood and we get contracts from potential customers. We say, hey, potential customer, we'll come and we'll mow your lawn twice a month, okay? And you'll pay us $300 a month. But we expect to be paid up front. So in March, Zach and I, we go around the neighborhood and the customers, they pay us, yeah? They'll pay us before we mow their lawn. That is called unearned revenue, and it is a liability. Here's why. Revenue only becomes earned when you perform the good or the service. It is unearned revenue if the customer pays you before you provide the good or the service. So if we ask for our customers to pay us up front, that is unearned revenue for the business. It is a liability. The reason why it's a liability is because that customer can cancel that contract and get a refund before we even perform the service. Therefore, it's a liability to the company. It becomes earned revenue when we go to mow the lawn. After we mow the lawn, we take it out, we do this thing called an adjusting entry at the end of the month. We would debit unearned revenue and credit revenue to change it from unearned revenue to revenue. Does that make sense to everyone? It's pretty clear.
Yes, sir.
Yeah, I just had a question.
Yes, please.
Makes sense.
So unearned revenue, would it also be accounts receivable? Because it's not technically like, no, not at all.
No, not at all. So,
Okay.
so good question though. So accounts receivable, we would only generate an accounts receivable when we have delivered the good or the service to the customer and they haven't paid us yet. That would be accounts receivable. That's the only time we would use accounts receivable.
Okay. All right. I thought because like the transaction was still occurring, the exchange is still occurring, so I thought, okay, maybe would qualify that as account receivable. But
Right.
okay.
Good question. But yeah, we only recognize it as account receivable when we deliver the good or the service. It's unearned revenue if we've received the cash but have not yet performed the good or the service. Good question. Good question. Very well done. So those are liabilities. Remember, liabilities, anything the company owes to someone else. Equity accounts. Equity accounts, remember, this is what the owners own. Owners own, that's equity. Equity is the difference between assets and liability. Now, you can rewrite the accounting equation. The accounting equation, as you know it, is assets equals liabilities plus equity. You can also write it as assets minus liabilities equals equity. right? That's the other way of writing it, right? So if you're ever confronted with a question on like a homework assignment for whatever reason, or maybe an exam, and it says what is equity? Solve for equity, right? Well, we know we can rewrite the accounting equation. We know what the assets are. We know what liabilities are. We don't know what equity is. So we could go assets minus liabilities equals equity. That's another way of rewriting the accounting equation to be able to solve for equity, right? Remember that this is like the basic math, right, that we learned a long time ago. If we have an equal sign and there's another sign, right, it becomes the opposite if we move it to the other side of the equal sign. So assets equals liabilities plus equity can be rewritten as assets minus liabilities equals equity. See what we did there? So if you're ever confronted with how do I solve for equity, that would be how you do it. You just rewrite the accounting equation. That's just a hint, yeah, a tip. Your equity accounts is what the owners own or the company owns. This would include things like owner's capital, owner's withdrawals, revenues, and expenses. Owner's capital is what the owners of the company invest into the company. I started the company by contributing cash to the company to get it started. I started the company by bringing in equipment to get the company started. That's owner's capital. That's me investing money into the business to get it up and running. That's me investing my own equipment into the company to get it up and running, etc. Owner's capital. It's also called owner's contributions, but it's mostly called owner's capital on most books. This other one's called owner's withdrawals. The owner can pay themselves out of the company. How do they do that? They do that through this thing called owner's withdrawals. It's like saying, hey, you know what? I'm going to pay myself. I'll take a withdrawal. So I'll write myself a check out of the company's checkbook to me personally. That's called an owner's withdrawal. I'm taking cash out of the business to pay myself, either to pay myself for like personal stuff, right? Owner's withdrawal, which is totally fine, by the way. Revenues, that's sales, and expenses. Those are your operating expenses like utilities, telephone, wages, etc. Your day-to-day operating expenses. Those are all parts of equity. And revenue minus expenses equals net income. We'll talk more about that when we talk about the income statement. So here's the expanded version of the accounting equation with all the different types of accounts. Assets equals liabilities plus equity. Within equity, we have owner's capital minus owner's withdrawals plus revenue minus expenses. If you go owner's capital minus owner's withdrawal plus revenue minus expenses, that equals total equity. But you can see all the different types of accounts within each category. So earlier I mentioned this thing called the chart of accounts. The chart of accounts is a list of all the different types of accounts that the business uses. So we can see the chart of accounts below, and it's categorized by the different types of accounts: assets, liabilities, and equity. The chart of accounts is organized by this, what we call liquidity. Liquidity. The word liquidity means how quickly we can convert something into cash. Liquidity. That's in business and in accounting, the word liquidity means how quickly can I convert something into cash. That's what it means to be liquid. Right? So when we look at the chart of accounts, the first thing that always shows up in every business is called cash. So account number 101, that's cash. 106, accounts receivable. 126 is supplies. 128 is prepaid insurance. 167 is equipment. The numbers are relatively arbitrary, but what they mean is every account Every account has a number associated with it. That number is the number of the account in the chart of accounts. All it is a unique identifying number for each account that helps to find where it's located on the chart of accounts. Make sense? Yeah?
Yes.
All right. Great. We're making good progress. I like progress. Progress is good. Okay. Now let's talk about debits and credits. Earlier I had mentioned that for every single transaction, there are two accounts that are affected. There are two accounts. From that chart of accounts we just talked about and all those different types of accounts, there are two of those accounts that are affected with every single transaction. One of them will be a debit account and the other one will be a credit. And all of that depends on the transaction. In accounting, there are two accounts for every single transaction. We call this double entry accounting. Let's talk about debits and credits. A debit account, we're either increasing or decreasing the amount. And the credit account, we're either increasing or decreasing the account. It depends on what type of account it is. And we can figure this out through this thing called a T account. A T account is just a visual representation of whether we're increasing or decreasing based off if it's a debit or a credit. Now on Monday, I had mentioned that to increase an asset account, like cash, for example, we debit cash. We debit cash to increase cash. Debit cash to increase cash. When we're increasing an asset account, we're debiting it. So if we're increasing cash, we're debiting it. If we're increasing inventory, we're debiting it. If we're increasing accounts receivable, we're debiting it. If we're increasing property, plant, or equipment, we're debiting it. To reduce cash, we credit it. To reduce inventory, we credit it. To reduce property, plant, and equipment, we credit it. To increase an asset account, we debit. To decrease an asset account, we credit. Left side debit, right side credit. And every single account looks this way, okay? The debit's always going to be on the left. The credit's always going to be on the right. Every single transaction starts with a debit account and ends with a credit account. So here's how it looks on the accounting equation. Assets equals liabilities plus equity. To increase our asset account, we debit. To decrease an asset account, we credit. For liabilities, it's the opposite. For equity, it's the opposite. Liabilities and equity are on the other side of the equal sign. To increase a liability, we credit it. To decrease it, we debit it. For equity, to increase equity accounts, we credit them. To decrease equity accounts, we credit them. We debit them. We'll talk a little bit more about the equity ones because with revenue and expenses, it gets a little tricky. To increase an asset, we debit. To decrease an asset, we credit. Liabilities, all liabilities. To increase a liability, we credit. To decrease a liability, we debit. Go ahead, Tamisha. Tamisha, you good?
I'm sorry.
That's okay. No worries. I just want to make sure you're good. You know. All right, cool. For equity. In most cases for equity, to increase equity, we credit. To decrease equity, we debit. Except for Owner's withdrawals and expenses. Owner's withdrawals and expenses have the opposite effect because of the accounting equation, of course. Owner's withdrawals. To increase owner's withdrawals, we debit. To increase expenses, we debit. Those are the only two types of accounts that are different in equity. And the reason for that, of course, is the accounting equation. Assets equals liabilities plus equity. Within equity, it's owner's capital minus owner's withdrawals plus revenue minus expenses. That's why it's opposite for owner's capital and expenses. I'm sorry, for owner's withdrawals and expenses. The visual representations are good, but it's helpful when we go through the exercises, and we're going to do that here shortly. On the T account represents the changes of that account. That's what a T account is. It's just a visual representation that represents the changes of that account over time. This represents about a month worth of transactions for cash. Okay, cash is used in a lot of different types of transactions, such as purchasing supplies, equipment, paying rent, paying salaries, paying for things that we purchased on credit, which is accounts payable, or paying bills, accounts payable, and for paying our owners. Cash coming in to the business is represented by cash received from our customers for sales, investments by the owners, and collection of accounts receivable. So remember, to increase an asset account, we debit it. So on the left side of this T account, we can see all of the cash increases. Cash received by the owner, $30,000. Consulting services from revenue earned, $4,200. That's a revenue account. Cash we received from our customers from accounts receivable, $1,900. Those are all plus, 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 right? On the left side, the debit side for any asset account, we are increasing. On the right side of cash, we're decreasing the cash. Purchasing supplies, purchasing equipment, paying rent, paying salaries, paying bills, paying the owner. Those are all decreases. So over the course of a month, I increased my cash by $36,100, and I decreased my cash by $31,300, giving me a balance of $4,800. $36,100 cash in minus cash out, $31,300 gives me a balance of $4,800. And we see that balance is on the debit side because it represents a positive cash balance. Make sense so far? All good, right?
Yeah.
I'm waiting for the equity side to ask my questions.
We'll get there, I promise. So as we're getting into the equity side, let's go through some transactions. I'm going to show you how to journalize them and record them. There are steps to everything we do in accounting. There's steps, okay? If you follow the steps in order, step 1, step 2, step 3, you'll be fine. You'll be fine. It's just a matter of following the steps. The first step to recording a transaction is identify those source documents. Those comes from things like purchase orders, sales receipts, bills, contracts, bank statements. Those are our source documents. The second step is analyzing those source documents to the accounting equation. The third step is recording the journal entries. And the fourth step is posting those entries to the ledgers. And so we'll walk through each one. Okay. So here is an example of a journal entry. There are 2 transactions here on this journal. The first thing we identify is the transaction date. When did that transaction take place? The date is so important. The reason why the date is important is because accounting is identified in this thing called accounting periods. An accounting period can be a month, a quarter, half a year, or a full year. Month, a quarter, half a year, full year. Those are called accounting periods. Okay. We typically do everything on a monthly basis. Yep. And the date of the transaction is so important because of, remember what we talked about, the matching principle. The matching principle tells us that we need to record revenue and expenses at the time they were incurred during the month that they were incurred, right? And the reason for that is because we need to allocate to those respective accounting periods. That's why that date is so important. When we record the transaction, we identify the accounts that are affected. Then, of course, we record the dollar amounts. And then might be a note associated with that transaction. In this first transaction on December 1st, we received cash as an investment from the company's owner. When we're receiving cash, we debit cash. Remember, to increase an asset account, we debit the asset account. So, debit cash. We see here on the letter B that cash is the first thing. Cash, the debit account is always the first one to be recorded, then the credit account. So we debit cash by $30,000. That's the amount of the investment. We credit owner's capital, $30,000. We see that the debit amount equals the credit amount. Your debits must always equal your credits in every single transaction. There might be more than two accounts in some cases. Most cases only two. Sometimes it's more than that. But either way, your debits must always equal your credits. So the first transaction, owner made an investment, cash $30,000. So debit cash $30,000, credit owner's capital $30,000. The second transaction, December 2nd, our company purchased some supplies, inventory. Our company purchased inventory for cash. We use cash to purchase inventory. So we debit supplies, which is our inventory account, $2,500. I'm increasing my asset account, $2,500. And I credit cash to reduce my cash by $2,500. I'm only affecting the asset side of the equation, but we see that it's still in balance, $2,500, $2,500. On the general ledger for cash, we can see what's happening with our cash account. December 1st, $30,000 went into the company as a form of investment from the owner. So debit, $30,000. This December 2nd, we paid some cash to purchase inventory, $2,500. December 3rd, we did something else, $26,000. December 10th, we got some money coming in, probably from accounts receivable, $4,200. And we see what's happening with the balance on the right side. What this image represents is the general ledger account for cash. It's basically a list of all the different types of cash transactions and what's happening with the balance. And you've probably seen, most of you have probably seen this before on this thing called your bank statement, right? And we see what's happening with your cash balance. Don't worry, we're getting to the equity here soon. So here's an example of an equity transaction. On December 1st, we received cash as a form of an investment from the owner. We debit cash to increase cash, and we credit owner's investment or owner's capital, which is an equity account, by $30,000. We debit the cash to increase the cash, and we credit the owner's equity by 30,000. So assets went up by 30,000. So did owner's equity by 30,000. And that's that transaction from December 1st. Good so far? All right. Thank you. What is the impact of these types of transactions on our financial statements? The financial statements are generated based off of transactions, right? Everything starts with a transaction. In business, everything starts with a transaction. A company starts with a transaction. So therefore, everything starts with a transaction. First, we process the transaction using the 4 steps we talked about. Identify the source documents, analyze the accounting equation, record the transaction through journal entries, and then post the journal entry. Those are the 4 steps. In processing the transaction, I've identified that we received cash from our owner as a contribution. I analyze what the effect of the accounting equation. It's going to increase my assets, cash, and it's going to increase my owner's equity. I record the transaction, debit, cash, credit, owner's equity, and I post that to my general ledger accounts. That's how we process a transaction. Here's another example. We purchased some supplies for cash, some inventory. First, I identify what happened. Then I analyze what's going on with the accounting equation. Cash went down, supplies went up, both asset accounts. So it's a net, a neutral transaction on the accounting equation. I record the accounting equation, debit my inventory, credit my cash, and I post those to my general ledger accounts. Here's another transaction. I'm purchasing some equipment. Equipment, as we know, is an asset. I identify what happened. I analyze the effect on the accounting equation. Cash went down, equipment went up. They're both asset accounts, so they equal out. I debit equipment, whatever it is, a truck, whatever, $26,000, and I credit cash, $26,000, and I post those to my general ledger accounts. Another transaction, I purchased some supplies on credit. Now remember, when you hear the word on credit or on account, on credit or on account, we're going to be using accounts payable or accounts receivable, depending on what the transaction is. But when we purchase something on account, we're using accounts payable. It means I've received my supplies, my inventory, but I have not yet paid for that inventory. I'll pay that later, usually within 30 days. So first thing I do is I identify what happened. I analyze the effect on the accounting equation, increase my inventory, assets. I increase my liabilities, accounts payable. I record the transaction, debit, inventory, credit, accounts payable. I post that to my general ledger accounts. Another transaction. I provided consulting services for my customers. They paid me in cash. Great. So I identified what happened. I analyzed the effect on the accounting equation, increase assets, increase equity. Why am I increasing equity? Because revenue. It's revenue. But remember, anytime you make a sale, it's revenue. So I debit cash to increase my cash. I credit revenue to increase my revenue. I post those to the general ledger accounts. And this transaction, I'm sorry, it's blurry. I apologize. Don't know how that happened. I can barely see it myself. In this transaction, we paid for an expense using cash. let's say it's rent. It's rent, $1,000. I paid rent for December. Analyze the accounting equation. Cash goes down, rent expense is my equity. Cash went down, equity went down, rent expense. The expense goes up, the cash goes down. So I record the transaction, debit, rent expense, credit cash. The reason why I debit rent expense is because to increase an expense, we debit the expense. Remember, expense is an equity account, but if we expand the accounting equation, we debit the expense accounts to increase them, right? We credit the revenue accounts to increase them. That's why it shows debit as a debit. Debit, rent expense, credit cash, to reduce my cash. Post it to the general ledger accounts. So another one, sorry it's blurry, I don't know why. I am paying an expense in cash for my employee. I'm paying my employees, paying them. This is their net. This is the employee's net. Identify I'm paying my employee $700. Reduce my cash. Salaries expense. Third thing I do is debit salaries expense to increase the expense. Credit cash to reduce my cash. And then the fourth thing I do is post them to the general ledger accounts. Yes, please. Tamisha.
I'm sorry. I'm so
It's okay. No worries. I know the whole WebEx thing. On this transaction, I'm providing services on credit. What that means is, remember, when you hear the word on credit or on account, we're either going to use accounts payable or accounts receivable. In this case, we're using accounts receivable.
accounts payable.
Yeah. So on credit or on account. So at any time you hear on credit or on account, it means that I am either going to use accounts payable or accounts receivable. I use accounts payable when I have not yet paid for that bill, right? Or I purchased something, but I have not yet paid it. In this case, I'm using accounts receivable because what I did is I, the business, provided my services to my customer on account or on credit. So what that means is I provided my services, but my customer has not yet paid me. Okay? So therefore, we will use accounts receivable. Accounts receivable, as you recall, is an asset account. We expect to receive the cash from our customer later on. It is an asset account. I have a claim to that cash. That's why it's an asset account, account receivable. So I debit my accounts receivable to increase my accounts receivable, and I credit my various revenue accounts based off of the sales I made. And then I post those to my ledger accounts. This is one of those examples where there's 3 different accounts being used. Another example of a transaction, we received cash from our customer based off of their account, on account, okay? So now I'm receiving cash. My customer, let's say this is a couple days later, now they're paying me. So remember, I provided the services to them on account or on credit. Now they're paying me. Okay, so a couple days later, now they're paying me for the money that they owe me for the services I already provided. So I'm going to increase my cash. I'm going to reduce my accounts receivable. I debit cash to increase cash. I credit accounts receivable to reduce the accounts receivable. And I post those to my general ledger accounts. Another example of a transaction. I'm not paying the whole bill. I'm paying part of a bill that I received. I'm paying $900 in cash towards a transaction that happened earlier. So I'm going to reduce my cash and reduce my accounts payable. I debit accounts payable to reduce the accounts payable. Remember, I'm debiting a liability account to reduce the liability. And I'm crediting cash to reduce my cash. I post those to my ledger accounts. So many different examples. Here's an equity one. The owner's taking some cash out of the business for personal use. It's fine. He's the owner. The owner can do whatever they want. So cash coming out, and it's an owner's withdrawal. So we debit owner withdrawals, $200, credit cash, $200 to reduce the cash, and post those to the ledger accounts. Another transaction. I'm receiving cash for future services. So this goes back to our lawn care business. Remember, we went around to various customers. They paid us before we take care of their lawn service. So we're receiving cash in advance of providing the services. Now, when that happens, it's called unearned revenue. If the customer pays me before I provide the good or the service, that's called unearned revenue. So I'm receiving cash, and I'm going to increase my unearned revenue, which is a liability account. So I debit cash, and I credit unearned revenue. I post that to my ledger accounts. Another example, I am going to pay cash for a year's worth of insurance. Okay? That is called prepaid insurance. I'm paying in advance for that expense. When you pay in advance, it's an asset account because you could always cancel that insurance policy and take that cash back. You have the rights to that cash that you paid in advance. So we look at the transaction, we analyze it, cash is going to go down, prepaid insurance is going to go up. We debit prepaid insurance, credit cash, post those to our ledgers. In this transaction, we're purchasing inventory for cash. Very simple transaction. Reduce my cash, increase my inventory. Debit the inventory account, credit cash, post those to the ledger. Another simple transaction, I'm paying cash for various expenses. In this case, it's a utility bill. Reduce my cash, increase my expense. Debit utilities expense, credit cash. Another transaction, I'm paying for salaries in cash. Reduce my cash, increase my salaries expense. Debit salaries expense, credit cash. Post those to the ledger accounts. We see how this works, right? Accounting is a lot about practice. The more that you practice these journal entries, the better off you will be in accounting. It's all about practice, right? I had mentioned that on Monday. Accounting is a practice. The more that you practice these types of transactions, you'll get really good at it, I promise. So let's take a look at the general ledger. Now, we just went through 16 different transactions over the past 16 slides. And in those transactions, I was affecting a lot of different accounts, right? And at the end of the month, I do this thing called a trial journal. And in this trial journal, what I'm doing is I'm validating that everything is accurate. That's why we call it a trial. And how do I validate everything's accurate? Well, I go back to the accounting equation. Assets equals liabilities plus equity. I take a look at all my asset accounts and I add them all up. 4275 plus 0 plus 9720 plus 2400 plus 26,000, 42,395. And then I add up all my liabilities. 6,200 plus 3,000 is 9,200. Then I add up all my equity. 30,000 minus 200 plus 5,800 plus 300 minus 1,400 minus 1,000 minus 305. 33,195. If you add 33,195 plus 9,200, you get 42,395. Assets equals liabilities plus equity. So the accounting equation is in balance. And that's how you perform a trial balance. List them all out. If it equals, it means you're in balance. And that's the beauty of the trial balance. Basically says all my debits equal my credits. You can list out all your accounts and the order of the chart of accounts, and we can see that our total debits equals our total credits. That's how you know you're in balance. It helps us to identify any errors. That's why we do the trial balances. If accountants we're not perfect people. No one's perfect. We all make mistakes. So how do we identify the mistake? We go through the trial balance, and that's how we start to look for any errors. If for whatever reason the debits don't equal the credits, there's a problem. If assets don't equal liabilities plus equity, there's a problem. And so then we go through the process of searching for the errors. We look at the trial balance. We take a look at, make sure everything's entered correctly on the ledger. Make sure the debits equal credits. We recompute the accounts to check for any errors. Verify that the entries are posted correctly. Verify that the original entries equal debits equal credits. That's the process of looking for any errors. If your debits don't equal credits, there's an error. If your assets don't equal liabilities plus equity, there's an error. And so we go through the process of looking for that error. It happens from time to time. It does. Like I said, no one's perfect. So after we've gone through the process of journalizing the transactions and performing the trial balance, now we perform the financial statements. We prepare them. The financial statements, as you recall, is the income statement, balance sheet, statement of cash flows, and the statement of owner's equity. On the income statement, we have revenues, expenses. Revenues minus expenses equals net income. On your balance sheet, we have your assets, liabilities, and equity. Assets will always be on the left of the balance sheet, and on the right side of the balance sheet, you'll have your liabilities and equity. Assets equals liabilities plus equity. We reconcile these accounts to verify that. So the beginning balance sheet, then we go through the income statement to get to the ending balance sheet. That's how they're all connected. Everything starts with the income statement. Everything starts with the transactions. The income statement is revenue minus expenses equals net income. The statement of owner's equity represents changes over time based on the owner's investments and withdrawals. The balance sheet represents the balances of your assets, liabilities, and equity at any given point in time. The statement of cash flows represents cash coming in and out of the business for operating activities, investing activities, and financing activities. You probably recall this slide from the previous chapter because I'm showing you how everything's connected, how everything flows. The income statement looks just like this. Revenues at the top, total revenue minus your expenses, total revenue minus total expenses equals net income. This is a very simple version of the income statement. Owner's equity is derived from net income. So at the end of each month, I take my net income amount, I put it onto my owner's equity. Plus or minus investments or owner's withdrawals gets me to my my balance for owner's equity. On the balance sheet, we have assets, liabilities, and equity. Assets will always be on the left, liabilities and equity will be on the right. The owner's equity amount at the end of the month or the end of the accounting period is transferred to equity on the balance sheet. When you're accounting in business, you're talking about numbers. Please make sure you have a dollar sign. If you're going to type something out, if it's a dollar amount, use a dollar sign. Use proper commas, proper decimals. Very, very important you do that. Anytime you're typing out a dollar amount, be very, very clear. Dollar sign, amount, use commas, use decimal points. It helps to make sure everything's clear. Yeah. The last thing you need is accidentally putting a comma in the wrong place or putting too many zeros in. Mistakes happen. But just when you're typing a dollar amount, just be very, very clear. Dollar amount, commas, decimal points. A ratio. I know ratios, right? I told you this wasn't a math class. It's not. It's not. There's going to be a couple ratios though, so it's kind of math. There's some math. There's some adding, subtracting, a little bit of dividing, but it's simple. Why is it simple? You're just plugging in the values. This one's called a debt ratio. The reason why business wants to know what the debt ratio is because they need to make sure that they have the ability to pay all of their debts, right? I want to make sure I can pay all my debts. How do I do that? I take my total liabilities and I divide that by total assets. If the amount is in this case, we look at this type of ratio to be able to tell me if the company has the ability to pay all of our debts. If the number is one or more, that's not very good, right? Because we want to have total assets greater than total liabilities in general sense. That means we have the ability to pay all of our debts. Now there was a question earlier. Forgive me, I forgot who wanted to ask the question, and it was about equity. Did I answer your question on equity, or did you have a different question on equity?
Yeah, I think I get it. The only thing that I kind of threw me off a little bit was the credit. And you said that debit would decrease the
Equity.
asset, the equity, and then crediting would
increase the equity. Yeah.
Okay. Yeah. I guess I get it now.
Cool. Great. Yeah. Awesome. I'm glad. I'm glad you got it. Yeah. We made it. Are there any questions, comments, concerns? You're good. You're all good.
Not for me, sir.
Okay. Thank you, Mike. Appreciate that.
I'm still processing. I may have questions next week, Professor.
Yeah, that's fine. Yeah. Anytime you have a question, you're more than welcome to reach out to me. I'll be here for you.
I guess I need to go over it again.
And that's fine. It's difficult to consume this much information this quickly. It takes some time. And remember, accounting is a practice. So the more that you practice the exercises, the better off you'll be. Quick note about next week. Next week, Monday, is Martin Luther King Day. The university is closed on Monday. So what does that mean? We'll have class on Wednesday. If you can't make it, that's okay. Again, these sessions are recorded. They'll be posted in the announcements area. They're also on the YouTube channel. So if you ever need to go back and rewatch something, it's there for you. Quick note about the homework assignments. Now, I know that some of you don't have your book yet. I understand. I'm flexible, okay? I'm not going to penalize you for late submissions, especially if you don't have your book. You know, that wouldn't be fair to you. So I want to be fair to you. So here's what I recommend. Chapter 1 quiz and Chapter 2 homework, they're technically due Sunday night, this coming Sunday, okay, the 16th at 11:59 p.m. They'll still be open. So if you need to submit those late, I understand. I know the textbook thing, right? I get it. To help you, even without your textbook, you can still attempt that quiz and that homework assignment using the PowerPoint presentation, your notes from the lectures, rewatching the lectures. It's open book, open note, all that good stuff. You have 2 attempts for every quiz and every homework assignment. So if you don't do that well the first time around, don't worry, you can go back and try again. The higher of the 2 grades will be accepted. So that's my recommendation. Give it a try. And if you don't feel like you're ready because you don't have your textbook yet, wait a little bit. It's okay. I'm not going to be upset if it's late. I might remind you that it's late, but I'm not going to be upset, and I won't penalize you. Okay, sound good?
Yes.
Sounds good to me, sir.
Yes, sir. I will try. I will attempt my first one. I probably try, and then I may wait on the book, but I will attempt to do it.
Sounds good, Miss Edwards. And if you need any help, you just let me know, okay?
Yes, sir. Thank you.
You're so welcome. Well, thank you everyone so much for your time today. I really do appreciate all of you and all of your hard work. If you have any comments, questions, or concerns, please feel free to reach out to me, email me, call me, set up office hours, whatever it takes. I'm here for you 100% of the time. As always, I want you to stay safe. Wash your hands, okay? You know, the whole virus thing going on. Wash your hands. Stay safe, wash your hands, do the right thing, and I'll see you all again next time. Have a wonderful evening. Thank you so much. Take care.